Last week, I was sitting with group of traders who have been in markets for years. The market was looking slightly bullish, and I just asked them a simple question. Are you still buying naked calls and praying for the move? And I suggested that why not look at some spreads. And as soon as I took this name, they all went silent. It made me realize something very critical. Even experienced traders are taking huge amount of risk to make small profits because they don't understand how to structure a trade. They think options are just about up or down. They don't realize that how the professional traders are playing a completely different game. So I decided to do this video and bring some clarity on some very simple structures. I'm going to show you a two-leg framework that can be used to stay calm while everyone else is panicking. By the end of this video, you will see exactly why the smartest money in the room never trades naked calls and why they trade these spreads. Welcome to another video by the Option School, and I am your friend Pradeep Singh. Most new traders or beginners rush into buying of options because it's cheap and profit expectations are very high, while experienced traders often prefer selling of options for the higher probability of success. And as we all know, a buying of option offers unlimited profit but carries a high risk of losing the entire premium. On the other side, selling of option gives you a high win rate but exposes you to unlimited loss if the market makes a big move. Most of us do get trapped in one of these two extremes. This is classic trader's dilemma. If you only buy options, time decay or theta eats away capital every single day. If you only sell options, a single big market move can wipe out months of gains. Is there a way to solve both the problems simultaneously? Yes, definitely there is a way. And if we follow this process with discipline, very low chance that anybody can take away money from the trader. Welcome to the spreads. We keep on using this word without even realizing that many of us either do not understand the meaning or do not appreciate the power of spreads. I'll try to clarify both the things today with real case study and comparison. A like from you will really help to reach out and motivate us to bring more such content. So please hit the like button. So what is a spread? A spread is a two-leg strategy where you buy one option and sell another option at the same time. By doing this, you are essentially using the sold option to subsidize the cost of option you have bought, creating a built-in hedge for your portfolio. And the best part, the margin requirements for spreads are very capital efficient. For a 50-point spread in Nifty, we only need approximately 35,000 per lot. There can be multiple kinds of spreads like bear call spread, bull call spread, call calendar spread, and so on. Main logic is there is a buying leg and there is a selling leg. All the numbers, profit possibilities, break evens change based on how we are using these two legs. Let us dive into real world example using call spreads to basically understand the spreads. Again, today I am talking about bull call spreads only. We will talk about other spreads in our other videos. Why bull call spread? Because already I have given you a video to adjust bull call spreads. You must be surprised which video. I'll reveal once I show you bull call spread and give you the link of that video also. Let's see a real example so that things become crystal clear to all of us. We have taken this example from November month. Nifty is at 25,678. If you simply buy a close to ATM call of 25,800, it will be for 307. Max loss is over 23,000 per lot, which is 307 multiplied by the lot size. If market goes down, this can be the loss in one lot. And if market goes up, there can be unlimited profit. Now, this unlimited profit is just a fairy tale story and it never happens. In fact, this whole equation of loss of 23k and unlimited profit entices traders to buy a lottery of 23,000 rupees. Let us check why I am saying this. If we see Greeks in this, the daily decay, that is theta, is around 673 rupees. So even if market goes up by small amount, price of this call may not increase but decrease. And if we see till expiry, like if I'm a working professional want to take trade and wait till expiry, even if market remains below 26,100, still some loss will be there. In case market goes to 26,150 on expiry, one will make around 42 rupees into lot size. That also is around 3,000 only. So it is very rare that you deploy 23,000 and make 2 lakh rupees profit. For that 2 lakh rupees profit, market need to make a move of more than 2,500 points before expiry, which is not impossible, but yes, very rare. In this case, on expiry day, market expired at 25,973, which is above the strike price of the call, but still you can see there is a loss of 11,000 rupees. Let us now see if instead of naked call, we engage with bull call spread, which means buy one call and sell higher call. In this case, again 25,800 call is purchased at 307, but 25,900 call is sold at 255. This makes it a 100 points bull call spread. Margin required is around 35 to 40,000 rupees. Max loss, as you can say, is only 3,900 rupees and max profit is 3,600 rupees. In this case, daily theta decay is very low. So one can wait in that trade without much stress as compared to naked call option where the theta decay was very high. So if few days market doesn't move, already we are sitting in a loss. On expiry day, same market, same month, this trade gave a profit of 3,300 rupees, almost giving 7 to 8% return on the capital deployed with same level of expiry. Let's do a very side to side comparison. Max loss 23,000 versus 3,900. Theta decay, daily decay 673 rupees versus 12 rupees. Profit and loss and expiry. In this real scenario, the naked buy lost over 11,000 rupees, while the spread made a profit of around 3,300 rupees. Hope this comparison make things very clear. Spreads have huge benefit over naked positions. We will see this in other kind of spreads also. And that very rosy, irrational expectation of making huge returns with small capital generally entices new traders for naked buying. This needs to be avoided. Let me tell you another interesting benefit in spreads. The spread trade gives you time and space to make adjustments also in case of a fall. So actually the risk is not even 3,900 rupees. In any case, in upside, there is no risk, it will be profitable. So only risk is on the downside. So for much lesser risk, we are making a great profit. What to do in case of a down move? I am leaving you with this video of ratio spread. Convert your bull call into a call ratio spread and try to make it a zero loss trade even if there is a fall. Please hit the like button and subscribe button if you have not done it so far. You can download TOS app from link given in the description. See you in the next video.